I think that's reflective of the cost of owning risk assets just being substantially higher today than it's been at any time in the past few years.
Which we should have known.
Said differently, we went from a period of no volatility to a period of real volatility.
Because we went from a period of the punch bowl to taking away the punch bowl.
100%. And as you take away that punch bowl, volatility comes and the cost of owning risk, the return you need to own risk assets has to increase.
It seems like it's at the margin, though. It shouldn't be killing us at 2.5%, 2.75%. And especially with tax reform and deregulation, is it just the slightest bit of changing the liquidity or the central bank's position that really affects us that much?
I don't think it's affecting businesses as much as it's affecting stocks. So I think most businesses, to Dave's point, are doing great. And there's very few businesses who aren't going to make a capital investment because short-term money costs 250 basis points. And if you think about the flattening of the yield curve, most businesses can borrow long-dated money now at really, really attractive rates of returns. So businesses are doing better than stocks right now. And it makes sense because as you pull the central bank stimulus away, owners degross, they sell assets, there's less liquidity. So one needs to find assets, I think, that have either real growth or needs to wait for valuations to reset a bit.
So that you're explaining why multiples contract
exactly
a little bit as rates go up.
Where do you see those big growth drivers being in the future? And what sectors do you think you should really pay attention to?
So I think the economy overall is good. There's a shift of where profits are. Labor costs are going up. There was inflation this year that caused concern on things like freight or being able to pass through goods and costs. So there's a shift of where profits are in the economy. But there's certain areas that have real growth that are doing great. And I think those trends are going to grow for a while. So I think you want to own businesses with secular tailwinds as there's a shift in profits. So you want high gross margin businesses where you have real pricing power. So if there is inflation in goods, you can pass that on. So businesses tied to enterprise software. Businesses are spending money on digitizing their businesses to find productivity. Consumers are spending money on payment technology. There's money being spent in this economy. We're growing our oil and gas production. So I think in an economy that may grow at 2 or 3%, there's going to be real winners and real losers, and there's going to be a shift as this reset occurs. So there's going to be real winners and losers.
Do you think we're moving into a new, I don't want to call it peak activism, but as the market actually gets more volatile, there's going to be more opportunity for activists?
And I want to ask you a question about that, too. What is a CEO or a typical investor, what do we miss when we think about activists?
So I think the world of activism is here to stay. There's lots of ways of expressing it, and it'll change. What I really think active investing is people acting like business owners in the public markets. That's really, really good. If I could define activism as private equity in the public markets, not good guys fighting with bad guys. We didn't invest in Yum Brands because David Novak was a bad CEO. We didn't invest because they had a bad board. It was the exact opposite. Yum had a great management team, a great culture, a great board. And our view as activists is we had an idea that could help make the business better. Was our idea similar to their idea? Turns out they were very, very concentric. We signed a confidentiality agreement with David after we invested. We all wanted to do the same thing, and we sort of said, we think we can help you do this better. And as Yum was going through change, they benefited from having a 5% shareholder who was aligned, who could lock up for several years and help execute a plan. So the media wants to describe it as sort of good guys and bad guys fighting. If it transitions, which I think it will in the next 3 to 5 years, where people are doing private equity in the public markets, it's not good guys and bad guys, it's business partners.
It also feels like some of the tactics, and I'm not putting you in this category at all, have gotten nastier. I mean, even if you think about whether it was Athena Health with Elliott. By the way, now you see companies, I don't know if you saw, this is different, but Qualcomm had hired Definers, which is the organization that Facebook was using with George Soros. I mean, it just feels like the sort of political tactics that used to be sort of off limits for business have now worked their way into the
But in a way that was
world.
Qualcomm trying to fend off.
Yes, absolutely.
The investors who are
exactly. So it's very interesting.
I think you get all of the above. The media is going to try to focus on the few food fight situations. Missing in that is all the opportunities where people are actually working together. So think about private equity guys. Think about the Silver Lakes of the world, putting money into MSG and going on the board and helping that company reposition, not because they're going to kick out management, but they think they can help add value. So I think you're seeing it from all different sides. And as these markets are colliding, and I think as you see market structure, you're going to have quantitative funds in the public markets. You're going to have multi-manager pods that trade the hell out of markets. and you're going to have private equity. There's a huge hole in the marketplace for people who can buy stocks and actually view that they're buying pieces of businesses.
By the way, can I ask you about actually if that's becoming too common? So lately people have noted that even at the Sohn investment types of conferences, not a lot of short ideas. You had, over the weekend, the founder of Value Investing speaking to the Wall Street Journal about his concern that the vanguards of the world are going to own all of these. Is there actually enough short interest? Even now, the activists who we might rely on for this are saying, no, we're going to partner with companies for the long run. So, who's watching the shop?
So there very well may not be enough securities for everyone to short. Ideas very well may be too crowded. I think all of that's correct. So if you accept that, it's sort of, if you're going to invest in the public market and make an outside return, it might actually help if you can make the companies you invest in better. So if you think about the concept of taking a private equity approach to the public markets, being able to invest in a great business, Yum Brands would never be for sale. A private equity firm could never buy Yum Brands.
So you would say to Jack Bogle, if you're worried about indexes owning about funds owning the entire S&P 500, people like you can help make sure that they're at least run well.
The biggest risk that people like me have is if the index funds own the whole S&P 500. There's an accountability in this country that's phenomenal because we have real capital markets. You need owners. So if I said, how do you balance that? The greatest thing in the world for me would be if Fidelity took over the index business.
When you hear, though, that
because they'd at least know how to vote and think about being passive.
When you hear about the Larry Finks of the world saying that he wants to be more active, do you believe that?
I think he's got to be, because ultimately he becomes the capital markets. It's the point Kelly was making. He's managing $2 trillion. It's in his interest to have a healthy, functioning capital markets. Our economy does great
$6 trillion
because of I discounted him. No.
From my perspective as CEO, activist, you have the good, the bad, the ugly. You really pray that you get the good. Having some bad guys come in is not a good thing. And I think one thing I can say about Keith is he did take a longer-term perspective about the business. We were aligned, and we would not have been able to execute our spinoff of the China business as well without his help. So, I think there's always a lot of trepidation. We had some other people come in that I got to tell you I wasn't nearly as happy with. Okay.
Talking about China, do you have a take on what's going on with the larger tariff story here?
I think I think the administration is tackling a problem that needs to be tackled. So people should be appreciative, and we probably kicked the can way too long. But it's a complicated problem. And each day we're going to have swings from hope to fear as to whether this gets resolved. I think ultimately it does get resolved, but I think it's very hard for the public markets to watch the sausage get made. So we're going to have a period of increased volatility, but at some point as you look forward, we're the two largest economies. We needed to have these tariffs if we were going to say we're going to reset things. So I heard it described by someone smarter than me as sort of a strike. No one likes a work stoppage. They never make sense, but sometimes you have to have them. No one likes tariffs. A little bit we had to have them because we have a legacy trade relationship, legacy IP rules, legacy state-owned intervention in China that all needs to be reset. To the Trump administration's credit, they were willing to take on a tough fight. I think it helps that the U.S. economy is doing well. I think the most important thing in all this is Powell being mindful of a dual mandate of both inflation as well as full employment and not trying to end the expansion.